Hello and a very warm welcome to the latest market update for the month of April with me, Andrew Dawkins, and
myself, Daniel Baverlock. How was the month of April for yourself, Andrew?
April was mighty fine, yes. A little holiday fitted in there, which was very, very good.
Managed to find some sunshine then?
Well, it was sort of 50-50, okay. But yeah, we've had a little bit, which was
better than here.
Yeah.
A difficult month, weather-wise. Anyway.
It's been a long winter, hasn't it? It started for us, I think, in July.
That's right. So how are the markets fared? Have they been a bit warmer than the climate?
Well, we've had a couple of months of really good reports for March and February, and we were bound to get a little bit of a hiccup along the way. So April generally has been down for most of the markets. We'll come to the winners in a minute. And I think there's a couple of reasons for that. One is there's a bit of profit taking. A lot of shares are sold off once they've hit a certain point, and then money is banked and then invested again. And the other thing is the difficulties in the Middle East with the Iranian attack on Israel and vice versa. And that spooked the markets more than the atrocities in Israel in October. So that took the shine off the markets. But I think generally the sentiment is reasonably good.
Why don't we start in the UK this month, Andrew? How did the UK perform?
Yes. So for a lot of our UK equity funds, the smaller ones, that was actually a positive month with the average of our smaller UK funds up 2.8% in April, which was good news. A bit of good news is that looking at the insolvency numbers, they fell 17% compared to February. So perhaps companies are doing reasonably well. Business optimism as well increased by, plus 9%, which means it's the highest level since mid-2021. The FTSE 100. Mm-hmm. We've been waiting a long time for this, haven't we? But hit new heights. Thanks to, predominantly the fact that we've got a lot of miners, we've got oil stock and pharma and financials in there. Shell, for example, makes up 9% of the FTSE 100 thereabouts at the moment, and they did very well. But also thanks to your Aussie mates, so BHP, which is Australian-listed miner, it used to be listed in the UK, but then moved over to your neck of the woods.
We're good at digging holes.
Yeah. So they offered to purchase Anglo America, which is a UK mining stock, really for their copper mines, because as we go greener, copper's likely to be in high demand, and as the world sort of starts to produce more as well, copper's in many things that we make electrical. So bids ongoing for that one, but it helped to drive up share prices. Good returns from the likes of Barclays, NatWest, Next, AstraZeneca, Reckitt, GSK, all delivering good returns, good results above average. And interestingly, lots of Sainsbury and Tesco are reporting that more customers are now buying their branded items again, the finest or the best of, or whatever they call their top shelf stuff, which is indicating perhaps that the consumers are feeling a little bit more affluent and able to dig a bit deeper into the pocket to buy the best of the best, if you believe that. So it's reasonably good news for the economy. The only thing that's the worry, we've been harping on about this for ages, is the size of the UK's national debt, the amount of debt the government has, which is now at £2.7 trillion. That's almost 100% of our GDP. In other words, the value of what we make and sell and services and all the rest of it over a year. So it's a huge level. And actually the amount of interest we're paying on that is almost equal to the amount we spend on defence. So really the government needs to look at ways of cutting the debt substantially. It goes on and says, well, our debt's not as high as the debt they've got in other countries around the world. But even so, it's no good thing. And we need to do things to, I think, stimulate the economy, bring in more taxes, And increasing taxes and reducing thresholds and allowances is not the way to do it, because it disincentivises where I think what you need to do is to reduce taxes to make it, well, so you've got more sort of ability to, if I make more money, I keep more of it. And it incentivises companies and individuals to work that bit smarter, get our production going again, get the economy moving, because we need that growth to repay the debt.
We've looked at the UK. We travel not very far down to the EU. How have they performed?
Yeah, so Europe, excluding the UK, it was, funds down actually. A lot of the continental Europe, as it's called, excluding the UK, funds were down. Actually, it's our biggest fallers this month. But actually, the economies are doing reasonably well. Germany's finally started to even out and putting on a bit of growth now. And I think most of the indications are that the Eurozone is now out of recession and the economies are growing and putting on decent growth. So again, I think the worst is behind us, and we should start seeing some good figures coming through once again. Inflation is down across the Eurozone, averaging out now 2.4%. So it's getting near to this silly 2% target that's been arranged all over the world. I'm not sure where they get this figure from. It started in New Zealand, apparently, the 2% target.
Surprising, Kiwis.
Yeah, what are they like? A lot to answer for. So it does indicate that probably the European Central Bank might be the first bank to actually start to reduce interest rates later on in the year, which will then increase confidence just a wee bit further. But Euro zone for April down in terms of the funds that we look after, but generally the economies are starting to pick up now.
So that's the UK and Europe done. So why don't we travel to the rest of the world and see how they fared last month?
Okay, well, the emerging markets sector, that was the second best performer this month, with most of our emerging market funds averaging another 2.8% return positive, which is good. There's some very good countries out there in terms of actually growing economies. The difficulty is that there aren't a great deal of companies that are not listed elsewhere in the world, and the market's somewhat limited, I think, in terms of scope. But nonetheless, some good returns there. The likes of Japan, well, that's still suffering a wee bit, and especially its currency, the yen, fell to a 34-year low against the dollar, and it's meant that the Japanese tourists are thin on the ground at the moment. It used to be one of the most travelled nations in the world, whereas now they're actually seeing an increase in tourism as the likes of the dollar and even the pound and the euro is buying more yen, so it's perhaps a place to visit. Dan, have you any thoughts of visiting Japan?
I have. I've always wanted to visit Japan. I think I might have mentioned it to you. I've got my cherry blossoms.
Yes, why wouldn't you? The currency that's done very well against the dollar has been all powerful this year, is actually the Argentinian peso. And that's up 25% so far this year against the dollar. So perhaps defer taking a holiday to Argentina?
Tick. Yeah. Done. Have you left the best till last, the US?
Well, this month the US funds, some of them are down, some of them are up. So we've got sort of mixed results over there. Overall, though, in the US of A, then things are continuing to look fairly bright, although the economy in the first 3 months of the year didn't grow quite as fast as the experts, the clever people, just as clever as you or I, were expecting it to grow by, but it's still positive growth and it still beats most of the world by a margin. So that was positive. The number of unemployed in the country, that's continuing to fall, although the number of vacancies is also down, but generally what's considered a tight employment market is good for wages, which actually increased by more than inflation. Inflation increased slightly in April, again confounding many of the experts, but the experts miss the point again and again. We make this, that if you put up the cost of borrowing, it increases inflation. So they're saying inflation is very sticky. Well, it will be sticky with interest rates as high as what we've got at the moment. So that will take a wee while to filter through. But nonetheless, consumer confidence remains high. Some good results from many of the big companies, especially in the tech side. Not so good results from the likes of Starbucks, McDonald's and Coca-Cola, which have noticed that at the lower end of the spending scale, people are cutting back. So even on a Starbucks coffee or a Big Mac, not as many people buying them. So Coca-Cola's answer to this apparently is to make even bigger bottles of Coca-Cola for those people who can't quite afford it, which I don't know that that's such a good idea, but anyway, that's the way they're tackling it, which is interesting because in the UK we're starting to see more consumers move towards the big branded items, and in the US there's still this sort of move that the people that don't have that much have got even less, even though that generally wages are increasing faster than inflation. And then finally, just a little interesting fact here, when we compare the Chief Executive Officer's pay packet in the US against the UK, so the average CEO boss's pay in the US averages £18 million a year. Not bad. Compare that to the FTSE 100 CEOs, where they're averaging a pay packet of just under £4 million. So I think you've got to feel sorry for any chief executive officers in the UK. That must be hard to get by on. £4 million.
Incredibly, we are a third of the way through the year, so it might be a good idea just to give a bit of a summary as to where we're at and maybe what the future holds, Andrew.
Yeah, well, I think we're back to more like normal times in that we'll get months when the investments go up and we'll get months when the investments fall in value. But long term, as we said from the year dot, we make money if we take out the market movement short term. Longer term, we do nothing but make money, and that's the main thing. But I think the world's there's always difficulties, there's always challenges, and there's always going to be something to moan at. But generally, the first third of the year has been very encouraging and positive for most of the investments that we look after. There's still some sectors that are languishing. Unfortunately, the more specialist areas of sustainable and ethical investing are still feeling it because they tend to recover last. What happens is money comes away from the smaller, ethical, sustainable types of investments into the bigger corporations, companies where there's safety in numbers, and then once people can start seeing that the growth in those areas is slow, they then move back into the smaller companies, and then we get a big boost. Other area to still be wary of is the fixed interest, lending money to companies, lending money to governments, which we've got inflation levels that are still not down to the levels that they should be. There's still ones to be wary of. So we keep our eyes on the fixed interest sector, but it's one really that has been very, very difficult ever since 2008 and the quantitative easing. And just on that point, we've found out the latest estimate from the Bank of England is that quantitative easing has cost the UK taxpayer around about £85 billion to actually finance. Hefty number. Which I'm not sure it's been the greatest success story in the world. But anyway, it was what was done. We can't change that. But I think for the rest of the year, I think it's an encouraging position, and we should be ending the year making profits in most of the sectors that we get involved with.
As we do every month, we'll go through the ARD consultancy portfolios and their performance. Little something special this month. For the 1 month, every single portfolio is down by 1%. So we'll skip that and we'll move to the 1 year, 5 year and 8 year. And we'll start with defensive.
Over the last year, up 8%. Over 5 years, up 18%. And over 8 years, positive 47%.
A cautious portfolio.
This year, up 10%, over 5 years, 27%, and 8 years, up 71%.
A balanced portfolio.
Over the last year, up 12%, over 5 years, 38%, and 8 years 96% positive growth.
Capital growth portfolio.
Over the year, up 13%. Over 5 years, 45%. And 8 years, 119%.
And finally, the aggressive portfolio.
This year, up 14%. Over the last 5 years, 52%. And 8 years, 141%.